Okay, so we're making really good progress here. This is the final part of our exercise. It is time to use the T accounts that we created earlier in order to create a balance sheet and an income statement. The first thing we need to do is calculate the total for each of the accounts that we have. Let's draw a line below each of the accounts and calculate the sum of its left and right columns. For the cash account, we would have the following: 3,000 plus 1,200 plus 2,700 on the left side, and 1,000 plus 250 plus 150 plus 900 plus 200 on the right side. The sum of the left side is 6,900. While the sum of the right side is 2,500. In order to obtain the final balance of the account, we need to take the difference between the two sides. The same goes for the two accounts below. The balance of the PP&E account is 900. While the one of the raw materials is equal to 100. On the right side are all liabilities and equity. However, there is one slight difference. When we calculate their balance, we need to subtract in the opposite direction. So, for example, when I calculate the balance of trade payables, I will take the difference between 250, which is on the right, and a hypothetical value which could have been on the left side. And here we will have total liabilities and equity. Now we are ready to make the sum of the two columns. Something is not correct. The accounting equation is not satisfied as assets are not equal to liabilities and equity. I'm sure you know where the mistake is, right? We need to calculate net income in order to balance the balance sheet. Given that net income is part of equity. Right now, an important part of equity is missing, and this is the reason why the balance sheet does not balance. First of all, let's calculate the balance of the P&L accounts that we have. When we calculate the balance of income, we do it by subtracting the right from the left column. while when we do it for costs, we need to subtract in the opposite direction. All right, here we are. We've calculated the balance for each of the income statement accounts. The income statement is a straightforward presentation of a company's revenues, costs, and net profit for the time period that it covers. The top line shows a company's revenues. The next line usually subtracts cost of goods sold. The sum of revenues and cost of goods sold gives us gross profit, a figure that allows us to understand what the margin of sales was. Below, we need to subtract other costs, such as utility expenses and D&A. If we assume that the firm does not have to pay taxes, we would arrive at net income. Okay, very well. Let's include the figures that we have in our T accounts. For the sake of clarity, we will include revenues with a positive sign and costs with a negative sign. That is why I'll have to place a negative sign in front of costs. This makes things much easier, as at all times we know that the number we are dealing with is a cost. After all the numbers are in place and we subtract costs from revenues, we would obtain the net income that was generated by the business throughout the period under consideration. This is the economic value that the firm produced for its owners. As we already know, net income is part of equity. Every year, the income that the firm produces feeds its equity account, due to the fact that income belongs to the company's ownership. In this case, it is positive and will increase the company's equity. Let's add the net income result to the equity account in our balance sheet. As you can see, the two sides are now balanced. Net income was the missing piece, which allowed us to satisfy the accounting equation. This shows that we have worked correctly when making entries. Perfect. The income statement and balance sheet that we created in this exercise are rather short because the example that we considered is very simple. Despite that, this is a complete exercise. I am sure that at this point you've learned all the important mechanics in bookkeeping and drafting of financial statements. There is a lot more to be learned, but this is already a very solid foundation. Congratulations for completing this exercise.